Welcome to this explainer. Today we're going to unpack a massive hidden threat to the global mortgage industry, the very real financial danger posed by extreme weather. When we see extreme weather on the news, our eyes are naturally drawn to the immediate physical devastation, right? But behind the scenes, there's this incredibly complex, totally unseen web of financial risk that threatens the very foundation of how we buy homes.
So let's dive into this by asking a pretty provocative question. When a hurricane completely destroys a home or a massive flood washes through a neighborhood, what actually happens to the mortgage attached to that property? The physical house might be compromised or even gone, but that financial contract? It absolutely remains. How did the massive lender handle thousands of those contracts suddenly being at risk all at the exact same time?
To figure that out, we are starting with Section 1, Weathering the Financial Storm. We really have to look at the mortgage industry not just as a bunch of banks, but as the bedrock of our communities. The industry provides an essential public good by enabling consumers to purchase homes, which drives our overall home ownership rate. So the crucial takeaway here is that any systemic threat to this industry isn't just a headache for Wall Street, it literally impacts all of us, our neighborhoods, and our ability to build long-term wealth. It's really helpful to think of this risk like an iceberg. While the news cameras are busy showing us the visible damage, the blown-off roofs and flooded streets, there is a massive financial danger lurking just beneath the surface. We're talking about the threat of plunging asset values and cascading loan defaults. If a lender holds thousands of mortgages in an area hit by a catastrophe, the financial contagion could just wreck their portfolio.
So how exactly does that happen? Let's move to Section 2, from damage to default.
Okay, let's walk step by step through this domino effect. Step 1 is the extreme weather event itself. Then, bam, we hit Step 2, property devaluation. Crucially, the homeowner might be uninsured or severely underinsured for the damage. Because they're suddenly forced to pay completely out of pocket just to survive or rebuild, we hit Step 3, missed mortgage payments. And finally, if that financial burden is just too heavy, it leads directly to Step 4, loan default. The data explicitly links the increased frequency of climate events to this exact chain reaction. If this domino effect is the problem, how are the professionals tracking it? Let's check out Section 3, Measuring the Climate Threat. The industry is turning to some highly robust frameworks to get a grip on all of this. Specifically, they're using the Sustainability Accounting Standards Board, or SASB standards. These standards give the mortgage finance sector a uniform way to measure and disclose environmental risks to mortgaged properties. It basically lets investors and the public see exactly what's going on behind the curtain.
But what exactly are they measuring? Well, the focus is strictly on weather-related events. We're talking meteorological events like hurricanes, hydrological events like floods, and climatological events like heat waves and wildfires. And crucially, they explicitly exclude geophysical events, so things like earthquakes and volcanic eruptions aren't in this specific climate risk metric. It's highly targeted on the weather. Once they know what weather to track, they bring in the hard math to predict the fallout. Lenders calculate something called expected loss. Simply put, this is the sum of the values of all possible losses for mortgage loans, multiplied by the probability of that loss actually occurring. It's essentially a mathematical way to price in the risk of tomorrow's storm today. And what if a weather event forces a borrower all the way down that domino chain into default? Well, lenders track the loss given default, or LGD. LGD tells the lender exactly what percentage of that property's value is just gone for good. Lenders are now required under these standards to disclose their expected loss and LGD specifically attributable to weather catastrophes, broken down by geographical region.
Speaking of geography, let's zoom in on Section 4, the 100-year flood zone.
Okay, we definitely need to unpack this jargon. A 100-year flood zone is a phrase we hear all the time, but it's honestly deeply misleading. You hear that and think, oh, I'm safe for 99 years. Actually, scratch that. It simply means a land area is subject to a 1 or greater chance of flooding in any given year. It is entirely about annual probability, meaning you could absolutely get hit by a 100-year flood 2 years in a row. No question.
It really all boils down to that single number, a 1% annual chance. Under the SASB standards, tracking the total number and the total dollar value of mortgage loans sitting in these 1% risk zones is now a vital metric. Lenders have to report exactly how much of their portfolio is parked in these highly vulnerable areas. And where are these areas typically located? Well, these 1% zones generally include coastal floodplains, the floodplains right along major rivers, and low-lying areas subject to pooling or ponding. These specific pockets are where the risk of property devaluation and underinsurance absolutely peaks when extreme weather rolls in. So, we know the risk, and we know how lenders measure it. Let's look at Section 5, Rewriting the Underwriting Rules. How does this data actually change the way you get a mortgage today? Well, there's a massive shift happening. Standard underwriting historically focused mostly on borrower credit risk, your credit score, your income, and the current appraisal value of the house. But climate-adjusted underwriting changes the whole game. Originators must now analyze inherent location risk. They have to factor in whether more frequent natural disasters will increase the likelihood of default, specifically because properties in that area might end up underinsured. What's really fascinating is how granular this gets. The standards ask lenders to disclose how they adjust collateral valuation based on these risks. This means they're literally assessing the physical adaptive measures of a house. Did you install hurricane shutters? Have you added structural reinforcements? Doing those things could literally alter the financial collateral valuation of your property in the eyes of a lender because it mathematically lowers their expected loss. So let's wrap up our explainer with a thought-provoking question. As the hidden link between climate risk and mortgage finance becomes impossible to ignore, and as standards force lenders to rigorously price in extreme weather, will your local weather forecast eventually dictate your ability to get a home loan? It's a huge shift in how the financial world views the physical world, and it's something every current and future homeowner absolutely needs to understand.